Hello, and welcome to the AAMA Mid-Quarter Market Commentary. I'm Bob Baker, President of Advanced Asset Management Advisors, and joining me today is Phil Volker, AAMA's Chief Investment Officer. Good morning, Phil.
Morning.
How are you?
I'm doing well, thank you.
Super. Well, we've had a lot of elephants in the room to deal with, and we keep getting a few more shoved in there, and hopefully the room won't explode. But there's a lot of ingredients affecting the market today, so we thought we'd kind of review what we think are the major ones and have a nice general discussion. But let's kick off with tariffs. Can you kind of give us a tariff update?
Well, I haven't checked in the last 5 minutes, so it may have changed. But obviously, things have been moving quickly over the last 4 to 6 weeks. If you look at the status a week ago, the expected overall tariff rate for all imports in the United States was at 23%, which would be a new high for the United States, even higher than what was imposed in the Smoot-Hawley tariffs in the 1930s. Since then, with the relaxation of the very high tariffs on China, that overall rate would today be, well, I guess as of yesterday, 13%. But there's talk now or threats of something higher in Europe, so that number could go up. But right now, for what is currently in place, it's 13%. And that the drop from the 25 to 13 is probably one of the reasons that the market has improved quite a bit in the last month.
And the bottom line is somebody's got to pay for a tariff if the tariff's going to be applied, and that's either the producer, either it eats it in its expenses and keeps prices the same, or they increase prices and the consumer pays for it. So that's kind of the catch-22, I think, right?
Certainly, and of course, there's the importing company as well that can absorb some of that. So sure. It's either two of those are profit margin questions, and the third one is inflation question.
Right. Let's move on to market valuations and how things have changed in the last few weeks or month.
Yeah, the high of the market in February, the forward PE of the market got up to 22 plus. So it was in the danger zone or the high risk zone. The correction in April took it down to 18.5, but it's rebounded quickly. And so right now we're at 21.5, which is still pretty high. So we're in a high risk area as far as valuation goes. And you lay that next to what's going on with the interest rate complex, and with the 10-year hanging around 4.5, the earnings yield of the S&P 500 at 4.6. So basically, you have a zero equity risk premium when you compare the earnings yield to interest rates available. So the incentive to buy equities is much reduced when you can replicate the yield with treasuries. Along with that, you also have earnings forecasts for the next 12 months, earnings coming down. The annual cycle, usually the annual earnings expectation goes up for the first 2 or 3 months of the year as companies announce their year-end earnings, and then it declines. Almost every single year it declines. But this year it's actually declined more significantly than other years. So in February, we were looking at 17% growth in earnings this year, and now we're down to 11. So that's a fairly dramatic cut in earnings expectations for this year. So the higher risk PE with falling earnings is not an ideal case for the market at this point in time.
Sure. How about the recession topic? We've avoided a recession so far, but it's somewhere.
Yeah, there always will be one coming up. We've talked about this in the last 9 months in our commentaries, where last summer we opened the possibility for the window to develop early this year, and GDP growth was flattish the first quarter, and is expected to be about plus 1.5% this quarter. Part of that is because of higher imports. Imports negatively impact GDP. So any front running of tariffs actually depresses GDP growth. But we started to see signs in February of some weakening in some of the domestic components of GDP calculation. Consumption, private investment are definitely slowing down. So if you forget about tariffs, you forget about front running, there are some signs of the economy slowing, just not dramatically yet.
Now, here's a big one. The government debt rating downgrade again.
Well, it's Moody's catching up with the others. It's pretty much a non-event, I think, at least in my mind. It's a split rating until this downgrade. The default swap market is pricing U.S. credit as a triple B right now, not double A. But I think that pricing on near-term CDS is probably more a function of the debt ceiling increase question mark that we've had many times in the past, more so than it is long-term credit quality. But like any large country that prints its own currency, the eventuality of a default is minimal. But we have the age-old expectation that instead of default, you just get cheaper currency issued to pay off the debt.
How about the economy at large? Any thoughts on that?
Well, we have the same thing going on as has been going on for a while. Lower end consumers are hurting because of inflation, interest rates, housing prices being up so much. Higher end consumers are still spending. In aggregate, debt levels are not bad at all. So supposedly the consumer has room to continue, although there's no question that different segments of the consumer are doing much better than other segments. Inflation has remained sticky. The last 6 months annualized rate for the CPI is 3 versus 1.5 or 1.6 6 months ago. And the Fed's favorite supercore PCE is at 3.8 versus 2.8 6 months ago. So inflation is sticky.
Well, we really hadn't talked much about the tax bill this week yet, but it's there's a bill that's been proposed and now it's in the Senate, and who knows where that's going to end up exactly.
Yeah, and it certainly doesn't do anything to cut the deficit. Federal spending is still stuck at a pretty high level, and from what I understand, the tax bill doesn't do much to fix that either.
That's surprising. You would think that would have done more to correct the spending, but we'll have to see how that plays out. So, any other thoughts before we close today?
No, I think that covers it. We've had the market generally overvalued or close to overvalued now for 5 years. And there's been some ups and downs, but we made a new high in February. Now we're at a point where we're back into the higher levels of that. But I guess what that means is maybe more volatility ahead. And we have to remember that volatility is not always bad. Market can go up with volatility as well. So
Right.
it just points out the value of looking at the underlying statistics for the economy, the valuation of the market, and for investors to keep their long-term plan in place and not react to the headlines of the day. In particular, in the last 6 weeks, the headlines could have resulted in some pretty dramatic short-term whipsaws in the market.
Sure. And, you know, a lot of people talk about potentially selling out of the market for their portfolios. And, changing your long term or intermediate term asset allocation, which is driven by your risk reward parameters. If someone changes that in the middle of a high risk market or a volatile market, that can be a very risky long term move for investors. So, it's kind of hard to stay the course at times, but you got to really think about the potential impact on those asset allocation, reallocation decisions in the middle of a high risk market. What do you think?
Yeah, I agree. It's, there's been plenty of opportunities in the last 2 months to make some big mistakes.
Yeah, absolutely. So, well, thanks for your thoughts this morning. And we encourage our advisors, if you have any questions, to give us a call. We're happy to talk about the markets or answer any questions you might have. So thanks again, and we'll see you in a few weeks.